Hey everyone, welcome back to another dividend investing video. Consumer retailer Target, ticker TGT, has become interesting in recent weeks. Target is a dividend king that has been growing its dividend payment for 51 consecutive years. Target has been in the news lately, stirring up a lot of controversy, and even though they reported better than expected earnings on May 17th, shares have dropped 12% since that time. And Target is sitting below $140, and it's set a new 52-week low at the end of last week. Target has had a rough couple last years for their business, but are in general a well-managed company that has brought strong returns for shareholders, quality business. So today I want to do a deep dive and determine if Target is a company worth buying and holding at this point in time for value-oriented dividend growth investors. Shares have fallen quite a bit, but are they at a discount? Now, I've calculated a fair value for the stock based on some educated assumptions, and I'm going to share that with you as well. So let's dive in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. I want to make clear that I'm not looking for a political discussion on the controversy swirling around Target. There are strong sentiments on both sides of that debate. Getting into it is not at all the point of this video. I'm not going to get into this one in the comments, and I want folks to be respectful of each other. As I said, no opinions are strong here. I mean, just look at this Twitter poll I made. 35% of you who voted are saying that they'd be selling Target right now when it sits at its 52-week low. And honestly, that blows my mind. What I will say, as investors, we have to decide for ourselves what we are comfortable investing in. Now, if you choose not to invest in companies because you disagree with something they do or a product they make, that's certainly your right. But that is not the way I invest. For myself, I don't consider politics or morals when I'm making investment decisions. Look, as an investor, one of my most important jobs is to take emotions out of the equation and stick to the fundamentals of the business. I can find things I don't like about just about any company that I'm invested in. I own a good bit of Altria Group, but I think the products they sell are awful and have harmed a lot of good people. I own Vici Properties, which means I have ownership in casinos. And gambling has also caused a lot of harm to a lot of good people. I own Lockheed Martin. They produce weapons of war, which presents all sorts of ethical dilemmas. I own Pepsi. Their products have contributed greatly to the obesity epidemic. So whatever I think of Target, selling certain products or pulling products off their shelves in response to backlash, this is just not something I take into consideration in my own investment decision. And I'm sure we'll have comments about how Target has gone woke or how they're anti-LGBT because they pulled products from their shelves after the backlash, but that's not the point of the video. Their current controversy is really a no-win situation in the short term. It's going to upset some folks regardless. Now, I want to evaluate if Target is a solid dividend investment, setting aside any opinions on that stuff one way or another. But one thing I can say about the drama that is surrounding Target, it's temporary and it's going to go away. It will be forgotten like so many other crazy things that have gone on with Target over the years. Target will continue to operate its stores, and folks are going to continue to buy the products they sell. So if you believe in Target's future outlook, I would not be overly concerned. And I'll disclose now that I don't own shares of Target, but look, I own 24 stocks here in my public portfolio here on the channel, and I own probably another 20 or 25 in other portfolios. Right now, I just don't have a place for it. You can't own them all. Of course, it could get to a level where it becomes too cheap to ignore. In my opinion, it's not at that level, but I do think shares are becoming attractive now, and I'll show you why. Interestingly, when I started building this particular portfolio out last fall, I was between Target and Best Buy. I ended up going with Best Buy, which I saw and see as higher risk reward than Target. But I also have retailers Kroger and Home Depot in this mix. So look, I'm A-okay on retail at the moment here. All right, so let's get into Target. They are the 7th largest retailer in the United States based out of Minneapolis, Minnesota. The roots of the company go back to 1902 as the Dayton Company, but the first Target store opened in Roseville, Minnesota in 1962. As of 2023, they operate 1,948 stores in the United States with their discount store Target, the hypermarket Super Target, and smaller format stores which were named City Target and Target Express, but are being consolidated under Target branding. Additionally, in 2015, Target made an agreement for CVS Health to acquire all of Target's pharmacies and its clinic business, and these were rebranded as CVS Health Pharmacies. This is a deal which has helped propel both companies. They also have a financial services division that issues their Target Red Cards, which reward customers 5% off of purchases for being cardholders, and they run private label products which they sell in their stores. They also have an e-commerce division at Target.com, allowing them to remain competitive against the threat of Amazon. Now, at the time of publishing, shares have dipped below $140, and the stock is down over 8% year to date. The stock is just a buck above its 52-week low, and its 52-week high is $183.89. That's quite a drop. Over the last year, shares are down 15%. Last year, it was reported that they were dealing with record numbers of theft. I can't imagine this has anything to do with the fact that these stores have systematically taken out cashiers, leaving us, the customer, to do all the work in their ever-expanding self-checkout. And like most businesses in the space, Target's margins have been greatly affected by rising costs and the inflationary environment. Now, longer term, say we go back 5 years, from a total return perspective, shareholders of Target have outperformed the broader market, with Target having a total return of nearly 119%, while the S&P 500 returned 69% over that same time frame. And by total return, this accounts for price appreciation plus dividends received. But if we zoom out more, then Target is underperforming the broader market, but its 10-year total return is still a respectable 163%. But true, it doesn't beat the S&P's 209% total return over the last decade. But keep in mind, past performance does not in any way guarantee future results. Just the more informed we are, the better investing decisions we can make. In terms of valuation, Target is trading at a forward PE of 15.8, so it's at an 8% discount to its 5-year average. Not really a huge discount, but we can call it slightly undervalued by this metric and certainly looking better than it has in quite a while. It's also looking nice when compared to consumer staples sector as a whole, which has the sector PE of 21.8. Today, shares of Target are yielding 3.11%. This is 28% above its 5-year average yield of 2.42%. For myself, if I was owning it at a minimum, I would want to lock in a starting yield above 3%. So by this metric, I think Target looks attractive. Now here's a different view of the 10-year dividend yield history for Target. We can see as recently as 2018, the stock was yielding above 3.5 to 4%. So again, while 3% is a nice starting yield for Target, I think for me to become really interested and say, okay, I have to make space for this one, it's got to come down a good bit more, like let's say the 120s, where it's starting to get too cheap to ignore there. It's just not there yet for me. Now look, here is a yield on cost chart for Target's last 5 years. If you had purchased shares 5 years ago, your yield on cost would be over 6%. And this just means the yield on what you initially invested in the stock. You'd have also about doubled your money. So that is a lesson in buying and holding quality companies 5, 10, 15 plus years. It does wonderful things. This is a solid dividend stock, a dividend king, but is it a safe dividend? Over the last year, free cash flow has definitely been lacking. They were hurt, but over the next 12 months, things are looking to normalize as the dividend will make up 44% of forward free cash flow and 49% of forward earnings. These are considered to be edging high for retailers just because of their tighter margins. There is less wiggle room. Simply Safe Dividends gives Target a dividend safety score of 90. The dividend is considered very safe. The rating was reaffirmed a little over 2 months ago on March 14th, 2023. With their recent earnings beat, things are looking a little less bad. I imagine this rating is going to hold. So that dividend is paid out quarterly in the months of March, June, September, and December in the amount of $1.08 per share for a total annual payout of $4.32. The ex-dividend for the June 10th payment was just a couple weeks ago, and we should be hearing about the next dividend hike from Target in the next couple months when they announce September's dividend payment. I will caution, based on the trends we are seeing, 2023 is a year for slowing dividend growth almost universally across the board. So I don't expect Target to up this dividend by 20% like they did last time. I think we'd be looking more in the mid to high single digit raise, maybe 5 to 7%. If they can do that in 2023, they're doing pretty good comparatively to their peers. That's just sort of the reality of the current economic environment. But dividend growth has been solid for Target, historically extremely solid. Over the last 5 years, the dividend has been growing at an average rate of 10% per year. Very impressive when you consider the 51-year track record of paying the dividend. Solid dividend king. Revenues are up year over year in the last decade, with $71 billion in sales in 2014 to $109 billion in sales over the last 12 months. stellar revenue growth. Target has been aggressively buying back its shares as well over the last decade. Hopefully they're doing it more now as shares have become cheaper, but they've reduced outstanding share count from 642 million in 2014 to 463 million as it stands today going into June 2023. And that's quite a reduction in shares, which drives the value of remaining shares outstanding, drives it up. And Target has been covered by 35 Wall Street analysts over the last 90 days, 20 rated a buy, 15 a hold, giving it an overall rating of 3.97 out of 5, rated a buy. And the average analyst price target is $179.56, representing nearly 30% upside from today's prices. So Target looks good independent of dividend investing. If things turn around for Target over the next couple years, and shares should respond accordingly. Investors could stand to make a good bit of gains just on price appreciation alone. All right, so now I want to make some educated assumptions and come up with a fair value price for Target on our own here to see if we can determine a buy price. Here's my Excel sheet, and what I'm doing here is I'm taking the average of 6 different valuations because no one valuation model is perfect. I'll run through these quick, okay? And remember, these are my own numbers. I could be way off on my estimates. Take them with a grain of salt, please. We have Graham's revised valuation coming in at an estimated fair value, $94.96. With the current 20-year yield on corporate bonds is at 4.47. This has risen dramatically over the last 2 years and greatly affects this particular valuation model. I am assuming a growth rate of 4% going forward. And we have a dividend discount model, also called the Gordon growth model. This attempts to nail down an estimated value based on projected dividend growth. Target has a 5-year historical CAGR of 10% on the dividend. Dividend growth is generally slowing in the near term, as I stated, so I think 6.5% projected dividend growth going forward is reasonably conservative. Using a 9% discount rate, we're going to get an estimated fair value of $184.03. We have a discounted cash flow valuation, which takes projected value of future free cash flow and divides that by shares outstanding. Free cash flow per share for the next 12 months is $9.82 per share. And assuming over the next 5 years this grows at a rate of 4%, and after that a perpetual rate of 2.5%, given a 9% discount rate, we have an estimated fair value of $165.19 for terms of free cash flow. And the next couple valuations are relative metrics, which relies on the principle that things tend to revert to their mean over time. The dividend yield theory is simple. It says, what would Target be priced at if it was yielding at its 5-year average? And with a 2.42% 5-year average yield, if the Target was at that today, it would be valued at $178.51. The next one is the PE mean revision valuation, and this just tells us what Target would be trading at if its PE was at its 5-year average. The current PE is just about 8% below the 5-year average, and Target would be valued at $151.72 at its historical 5-year PE of 17.3. Finally, I put in the average analyst price target, which was we said earlier as $149.54. Now, averaging these 6 estimates together, this gives me an estimated fair value of $158.99, which is 14.5% upside from today's current price, which is below $140. Now, one more step I take here to determine a good entry point is we must apply a margin of safety of some kind. The more conservative you want to be, the higher margin of safety you're going to want. Say we apply a 10% margin of safety, that would give us a target buy price of $143.09. And right now, we're below that. But if we want a 20% margin of safety, that gives us a buy price of $127.19. And if we need an even higher margin of safety, say 30%, then I'd be adding to my watch list at $111.29. I think if it got this low, then I might be saying Target is just too cheap to ignore. And again, I want to stress these numbers could be way off. My assumptions could be wrong. I could have a bad calculation in here. Anything is possible, but I do think Target could be at a nice entry point right now for long-term minded investors, even though I'm not a buyer myself. As I explained, I just don't have room for it in my own portfolio, but I think the current boycott controversies, they've helped drive this price down, and I think in the long term that's going to be unwarranted. It's going to be forgotten about. Now let me know what you think of Target, and again, I'd really rather avoid the whole political debate surrounding it, but I want to know if you think the stock is a buy given all that's going on. Are you like me watching on the sidelines? I'm definitely going to have more on Target. This is a quality dividend stock, dividend king, and all this drama surrounding the company is going to go away And I think it's just presenting an opportunity. And if I had room in my portfolio, I would probably be taking advantage right now. If you're still here, please give this video a like for me. Help us out with that notorious YouTube algorithm. Appreciate that so much. You guys are my people. You have a wonderful rest of your day. And until next time, keep investing.